Today we're taking a closer look at a cornerstone principle in investing, diversification, and why in the current market it may not be what investors assume it is. For many investors, diversification sounds simple. I own the S&P 500 index, that means I'm diversified. It certainly suggests broad exposure, 505 companies across multiple sectors, but the weighting today tells a different story. Today, approximately 35% of the S&P is allocated to the tech sector. That means for every $100 invested, 35 is effectively going into tech. And it gets even more concentrated. For every $100 invested in the index, nearly $40 flows into just 10 companies, 8 of which are tech-focused or tech-adjacent. The remaining $60 is spread across the other 495 companies in the index. So the natural question becomes, does that truly represent diversification? Now, this concentration does not imply these businesses are flawed, far from it. They're innovative, global, influential, and in many cases, category defining. But share price performance alone does not determine investment quality. Because the S&P 500 is a market cap weighted index, higher stock prices lead to large market caps and larger index weights, and more investor dollar allocated automatically. That is structurally driven by price momentum, not necessarily valuation or fundamentals. It's important to understand the mechanism, not just the outcome. But here's the broader reality. The index is a representation of the market, but not the entire market. There are hundreds of high-quality US companies and thousands globally with strong balance sheets, competitive advantages, attractive valuations, consistent cash flow, and far less investor crowding. Yet many of these do not attract the same media attention or passive flows, and therefore do not experience the same price momentum. That doesn't diminish their value. If anything, it often presents opportunity. So the S&P remains a powerful core allocation. It has rewarded patient investors for decades, but it's also important to recognize it for what it is and what it is not. And right now, it reflects a strong market, but a narrow one, driven heavily by a select group of dominant companies in a single sector. True diversification means staying disciplined, looking beyond headlines, and ensuring your portfolio reflects opportunity across sectors, company sizes, styles, and geographies, not just the momentum on one core of the market. Thanks for watching FinTalk, and remember, strong portfolios are built, not inherited from an index. See you next time.